If you pay any amount of taxes to the government each year, you're going to want to watch this video to the end because you're probably wasting a lot of money. And unless you enjoy taking money out of your own pocket to make the Fed richer, you're really going to like this video. Did you know that in the US, the average single worker loses 30.5% of their income to taxes? This means that you're working about 4 months every year just to pay the government. Imagine slaving away at a job you hate every year and only getting paid for 8 months instead of 12 because the government takes the rest. I don't know about you, but when I first thought about it like this, it made me pretty mad. The average American doesn't even have an extra $1,000 in savings, yet they're giving away well over $10,000 a year in taxes. So what's the solution? Well, most people can legally save a lot of money in taxes every year, but they have no idea how to do it. It would be really easy for the IRS to start basic tax education campaigns, or maybe get the education department involved and start teaching financial theory in school. But let's face it, if people learned how to legally save taxes, the Fed would miss out on 100s of billions of dollars every year. So instead of focusing on basic financial education, they would rather have the school system teach us that the mitochondria is the powerhouse of the cell. Since the school system failed us, in this video, I will explain exactly how the tax system works in the US, some of the best ways to legally save on taxes, and I'll break down the most underutilized tax strategies that anyone can start using right away, whether you make $20,000 per year or $20 million. But just remember, this is not financial advice, so always consult a professional before making any tax or investment decisions. So fundamentally, if you want to save on your tax bill, you need a way of telling the government that you made less money than you actually did. Okay, I realize this sounds suspicious, but don't worry. I'm not going to tell you to run your money through the Cayman Islands or hide your cash in Swiss banks. There are 100% legal ways to report less income than you actually made, and you can start by contributing to a traditional 401k. Think of a 401k as a special savings account for your retirement. With a 401k, you can contribute up to $23,000 every year with your pre-tax money, which means that every dollar you put into it will reduce the income you report to the government by $1. Here's a simple example. Let's say you earn $50,000 a year, and you decide to put $12,000 into your 401k account. That $12,000 won't get counted as income for tax purposes right now, so it's like you're only making $38,000 on paper. This means you pay less in taxes this year, and also get to enjoy a lower tax bracket. If you live in New York, for example, this simple trick will save you about $3,000 in taxes every year. But it gets even better. Some employers will provide an incentive for their employees to save money for retirement. So they will actually match the money you put into your 401k, no strings attached. They might match your contributions dollar for dollar up to a certain amount. Imagine your boss saying, "You put in $100, here's another $100 for free." It's like getting a bonus just for saving for retirement. But there is a catch. You can't touch the money in your 401k until you're around 59 and a half years old, and when you start taking money out, you'll have to pay taxes on it. But that's okay, because it's meant for your retirement, when you'll need the money most. And when you finally start taking money out, even though you'll pay taxes on it, you'll probably be in a lower tax bracket by then since your income will drop. So if you plan on making a lot less money once you retire, which is pretty much the meaning of retirement, then a 401k is probably the smartest way for you to save hundreds of thousands of dollars in taxes over the course of your career. Now let's talk about another amazing way to save on taxes, a health savings account, commonly known as an HSA. This account was specifically made to help Americans with their medical bills, and it's pretty awesome for saving on taxes. Here's why I think the HSA is one of the best tax-saving programs ever created by the US government. First, when you put money into an HSA, which you can do up to $4,150 a year in 2024, you don't have to pay any taxes on that money. Second, when you spend that money on medical bills, which you'll probably have as you get older, you don't get taxed on that either. So, it's like getting free money to invest, and you won't ever pay taxes on it when you use it for medical expenses. In a 22% tax bracket, that's an instant savings of $1,000 for the time it takes you to set up an account, which you can do in like 10 minutes online. But there is one little catch. To qualify, you need to have what's called a high deductible health plan. In 2024, This means you have a deductible of at least $1,600 for individuals and $3,200 for families, along with some other fine print to follow depending on your state. But if you do fit the criteria, this is easily one of the simplest ways to save money on your taxes without doing much work. The third method for you to save money on your tax bill is one of the largest U.S. tax breaks in existence. And it's by taking advantage of long-term capital gains tax rates for investments that you hold for over a year. You see, if you were to buy some stock and sell it for a profit within 12 months, that profit is treated as earned income and taxed at your regular income rate, which can be as high as 37%, plus state income taxes. Clearly, these high tax rates can quickly eat into your investment returns. On the other hand, if you stayed patient and kept your investment for more than a year before selling it for a profit, you would have benefited from the long-term capital gains tax rate, which is usually much lower. In fact, the federal long-term capital gains tax rate is only 15% for those making between $47,000 to $518,000 a year, which is most of the U.S. population. This can lead to significant savings, especially for people with incomes above $50,000, but it gets even better. If you and your spouse file your taxes jointly and your combined income is less than $94,000 a year, your long-term capital gains can be entirely tax-free. Yes, you heard that right. Potentially zero taxes owed to the IRS on your investment profits. And here's an extra tip. Qualified dividends from stocks you've held for over 60 days also receive the same favorable long-term capital gains tax treatment. So before you consider short-term investments or risky options, remember the benefits of investing in high-quality businesses with strong fundamentals. And speaking of investing in companies with strong fundamentals, I recently found an amazing service to help you find these companies. Click the link in the description and I'll tell you all about it. As a thank you for watching this video, I'll include some investment research and 5 awesome stock picks for free. Not only is this style of investing generally safer and can offer better returns, but it's also a smart move when it comes to minimizing your tax bill. After all, there is a reason Warren Buffett has been preaching about buying and holding good companies with strong fundamentals for a long time. Okay, now the fourth method to reduce your tax bill is actually a personal favorite. Since a good portion of my personal income is through my online business, I fall into the self-employed category, and one of the best ways to save money as an entrepreneur is by setting up an S corporation or an LLC, which gets taxed as an S corp. Think of an S corporation as a special legal structure for your business. When you earn money from your self-employed work, you put it into this S corp. Then, you deduct your business expenses from it. What's left after those deductions becomes your profit. Now here's the clever part. With an S corp, you switch roles. Instead of being the owner who gets all the income, you become an employee of your own company. This change means you can give yourself a reasonable salary, just like any other job, and the rest of the profit is paid to you as a distribution. The magic happens because these distributions from an S corporation aren't subject to Medicare and Social Security taxes. That's a 15.3% tax you get to skip right off the bat. And trust me, it can add up fast. For instance, let's say your business makes $120,000 in profit each year and you pay yourself a $60,000 salary. By taking the remaining $60,000 as a distribution through your S corp, you're saving over $9,000 in taxes. But as usual, make sure to consult a CPA or financial advisor for your tax and investing needs. Moving on, let's talk about a few really interesting ways for you to save on your tax bill if you're a homeowner. Not a lot of people know about these, so I think you're going to find this valuable. Let's start with, first, the capital gains exclusion. The capital gains exclusion is a tax benefit for homeowners. If you've lived in your home for at least 2 years out of the last 5, and meet other requirements, you can exclude up to $250,000 of the profit from the sale of your primary residence from capital gains tax if you're single, and up to $500,000 if you have a spouse. Here's a simple example. Imagine you bought a house in 2019 by yourself for $250,000 and sold it for $500,000 in 2023. This means that you made $250,000 in capital gains, which in this case is just a fancy term for profit. Normally, you would have to pay 20% tax on this $250,000 profit that you made, which would come out to $50,000. But with this tax benefit, you would pay absolutely nothing. And if you were married, you could make up to $500, zero in capital gains, and still pay zero tax. The only downside is that this doesn't apply to state taxes, but still, A 20% tax savings is definitely worth keeping in mind next time you move. #2. 1031 exchange. A 1031 exchange is like a tax magic trick for real estate investors. So if you own rental property and you want to expand your empire, this one's for you. Using the 1031 exchange, when you sell one property and use the money to buy another similar one, you can delay paying taxes on the profit you made from the sale indefinitely. Let's say you sell a rental property for $200,000 and you originally bought it for $150,000. That means you made a profit of $50,000. Normally, you would owe taxes on that $50,000 profit. However, if you use a 1031 exchange, you can take that $50,000 and buy another rental property with it, let's say for $250,000. By doing this 1031 exchange, you don't have to pay taxes on the $50,000 profit from the first property right away, and all of a sudden you've just traded up without paying any tax up front. Before you get too excited, no, you can't do this with a primary residence. But if you own rental property, you would be stupid not to take advantage of this. #3 Depreciation. Including property depreciation when you file your taxes is a really smart way to save thousands of dollars a year in taxes. In fact, some wealthy real estate entrepreneurs offset all their income and pay $0 in tax even after making millions of dollars a year in profit. Because on paper they are legally showing a loss. Basically, at some point the IRS decided to assign your property structure a lifespan of 27.5 years. This is because properties deteriorate over time and you have to spend money on maintenance, which should be factored into the cost of ownership. Don't ask me why it's 27.5 years, it's just something they came up with based on their own analysis. What this means for you is that if you own a structure that's worth $275,000, you would take that, divide it by 27.5 years, and all of a sudden, now you have $10,000 a year in depreciation that you could write off against any profits. On a side note, if you wanted to take this one step further, there's a thing called cost segregation analysis that allows you to depreciate all of these items up front in a much quicker time frame. And then when you have nothing left to depreciate, you can use the 1031 for a new deal and start the process over again. This could potentially defer millions of dollars in taxes. But this isn't exactly simple or straightforward, so let's leave this to the professionals with their large legal and accounting teams. Finally, let's discuss the most powerful move you can make to save on your tax bill and essentially combine everything I mentioned so far. Just hire a professional tax accountant. For a lot of people, hiring a tax professional might seem like a waste of money, but that's why most people are broke. They will spend $1,000 on the latest smartphone without flinching, but paying a professional $500 to save them thousands of dollars a year in taxes feels like a waste of money. Even if you're an employee with a very simple tax situation, I think it's worth it to hire an accountant at least once to make sure you take advantage of all the different ways you can save money on your tax bill. You can make a note of this and then do it yourself next time. But chances are, your accountant will point out all the ways that you could save money that you weren't taking advantage of when you filed your taxes yourself. My philosophy is that a good accountant should save you at least double what you pay them for their services. Remember, investing in a business, whether your own or someone else's, is one of the best ways to legally reduce your tax bill. And if you want to invest just like Warren Buffett, I've found the best resource to help you do that. Click the link in the description and I'll send you all the information for free.